Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So President Trump says that he will meet with Chinese President Xi Jinping next month on the sidelines of the APEC summit in South Korea. Now, this follows a phone call on Friday between the two leaders, and Trump said it delivered progress toward finalizing a deal over TikTok. Here's Bloomberg's Stephen Engel in Hong Kong.
Well, they talked, and that's a good thing. And then they're going to meet in person for the first time since Trump took his second term. So that is good as well. And they've also come to basic agreement on the TikTok deal that has been obviously up in the air for quite some time.
Bloomberg's Stephen Engel there. Now, we'll have more on what this means for markets in Asia momentarily. We'll get the views of Alicia Garcia Herrero, chief APAC economist for Natixis. But we begin here in the States. Joining me now is Patrick Kennedy. He is managing partner at All Source Investment Management. Pat, thank you so much for making time to chat. So stateside, we had the equity market closing at fresh all-time highs Friday. That's for the S&P, NASDAQ comp, Dow Industrial Average. Are you a little nervous at these levels?
At 24 times next year's numbers, Doug, we're not putting new money to work at the index level. We're still taking shots underneath the index level, right, on certain sectors and names. But at the index level, we feel like things are a bit frothy. Whenever we're over 22 times forward, we feel like momentum has really taken hold of things, and you need to be really careful with new money. Therefore, at the index level in public equities, we're not putting a lot of new money to work.
So the Fed's message from last week was pretty clear. It looks like we've got at least two more rate cuts coming this year, and how many more in the next year we'll have to wait and see. But has that been fully discounted by the market now, Fed policy?
You bring up a great point, Doug, and that's kind of why we're trapped between a rock and a hard place here, because the old adage is don't fight the Fed, right? So when the Fed is cutting, you're supposed to put your pedal to the metal, so to speak, and overweight equities and that sort of thing. But I don't think we've seen the Fed cut into, a rate environment that's already producing, call it mid-teens earnings growth next year, a strong economy, no cracks to be seen, and AI now taking over the technology world, which is supposed to have huge efficiency benefits for companies across the board. So with the Fed cutting at such a time, we're kind of scratching our heads as to why, right? We do think that the market likes lower rates, and we think a lot of that was baked in over the last, call it 60 to 90 days. So we wouldn't really be chasing anything here, and we'd be more concerned with what the cutting will do down the road when it comes to inflation and even stagflation at that, when you look 12 to 18 months out.
I'm glad you brought up the long end of the curve and the stagflation worry. We're at 4.12 right now on the 10-year. I mean, could we go to 4.25, do you think?
I think we could. When news first came out, I shouldn't say it first came out, but when it was understood that we were going to have a rate cut in September, you saw the back half of the curve actually steepen, right? So you saw rates go up, the 10-year yield go up, which tells you that investors are saying, hey, there's going to be an inflation problem because of this. That's our take, at least, right? So when you see the yield curve actually steepen, when the Fed is saying they're going to start cutting, that's cause for concern when you look down the road. So when you have as much debt on the balance sheet as the U.S. government does, and you're now cutting and making money more loose, we think that can create an even bigger debt problem, because it basically gives you the go-ahead to take on more liability, more debt, right? So we think it's like pouring gas on a fire at this point, and we'd be really careful when it comes to any company or any asset class that's tied to interest rates going down to benefit.
So where are you finding opportunity?
Yeah, that's a great question. So 3 sectors we like: cybersecurity, software, and biotech. No secret that we've liked software and cybersecurity for a while. Cybersecurity, we think, is just a secular growth story. It plays right into the hands of AI. The better AI gets, the more cybersecurity we're going to need. Software is actually just the next step in the evolution of AI. First, you had hardware, such as NVIDIA, so on and so forth. And then you had the infrastructure plays, the big hyperscalers. And now we think software is really going to take the baton and start to run with it. So when it comes to biotech, that's us not fighting the Fed, right? It's us saying, okay, well, if rates are going to come down in the near term and we want a quick trade, biotech would be rate sensitive. However, that would be a short-term play for us, right? We'd look to get out of that within the next 6 months.
So we've got this deal now between the U.S. and China. Apparently, the U.S. operations of TikTok will be majority owned and controlled by Americans. This calls to mind the level of activity that we have seen in private markets versus public markets. How are you understanding this landscape right now? Are you more inclined to become involved in private deals than you are, let's say, playing in the public space?
Absolutely, Doug. Yeah, you know our firm is heavily involved in private markets. We feel like the valuations on the private side are much more attractive than on the public side. So we haven't seen much activity since 2022 on the private side. So rates shot through the roof, when inflation was at 9. You saw the public markets really recover from that over the last 2 years. You have not seen such a recovery in private equity. In fact, you're now just starting to see IPOs come back to the market like Figma, Bullish, and a few others. So we're now just starting to see that recovery take place within private equity. And I think it's just because it's more of an institutional stance in private equity where they actually want to make sure the path is clear before they put new money to work. So they're a little slower to grab onto the recovery. With that being said, we feel like it's a spring-coiled recovery because we haven't seen much activity over the last 2 years. So when rates do start to drop a bit, that's where we'd want to be. We're not saying that the market is going to, fall off a cliff or anything like that. We're just saying that with rates coming down, the natural instinct is to step in and be bullish. But with valuations this high in the public market, that's not the asset class that we would choose to ride that Fed wave. It would be the private equity markets and private markets in general.
So give me a sense of how a retail player would participate into the private space.
Yeah, that's a great point. So retail can do this simply by buying some of the private equity names like Blackstone, Blue Owl, Apollo. Now we're buying, directly into these funds for our clients. We want, either a GP or an LP stake, direct participation. But if you want to get exposure to this within the public markets, a great way to do it is just buying the companies outright, right? So Blackstone is going to participate with all of their investors within their fund. Same with Blue Owl, same with Apollo, Carlyle, so on and so forth. Now, we're not saying that they're all equal, right? We wouldn't just blindly buy that bucket of names, but we would say, for a retail investor that wants to take advantage of all of this pent-up demand within private equity, take a look at that sector and pick a couple names you like.
Pat, before I let you go, I want to get your take on what you're seeing offshore these days. Over the weekend, a group of senior members of the U.S. House arrived in China. This is the first official visit we have seen at this level in about 6 years. Premier Li Qiang was at the Great Hall for kind of an official kickoff, and he called this an ice-breaking trip. Now, we know the U.S. and Beijing are trying to work out a new trade deal. Mentioned the TikTok story a moment ago. That's obviously a part of it. How are you feeling about markets in Asia right now?
Yeah, unfortunately, our stance really hasn't changed much, right? So China, we'll definitely trade it, but we won't stay as a secular investor, a long-term investor, just because we've seen so many investors get kind of fooled out in the past where it looks like this secular growth story is pulling together within China. You see a lot of bullish demand and pent-up demand start to flow that way, and then all of a sudden something happens within the government that changes all of that. So as an investor into China, you don't have the same sort of control as you do here in the US, and therefore you don't have a stable foundation. You can say, hey, I can put my money where my mouth is and go purchase a few good Chinese names for the next 10 years. With that being said, we do think that there's a lot of momentum within some of those China names. You're seeing it right now within Baba, JD, the K-Web, so on and so forth. So we wouldn't fight that momentum. We would just treat it as a trade rather than a long-term investment. when we are looking at longer term themes overseas, our answer still hasn't changed. We like India a lot. We feel like that's a growing economy. It's a more maturing economy. And then Japan has just been doing phenomenal across the board for the same reasons that, well, a little bit different than India. We do feel like it's becoming a more mature economy in Japan, but it has been for a while. The Japan story is really about inflation and coming out of a 20-year deflationary period that was really set on fire by the most recent inflation kick.
And the news last week on Friday when the BOJ said it's going to begin offloading some of the massive holdings it has in exchange-traded funds. I think that number is a little north of 500 billion US. Pat, thank you so much. Patrick Kennedy there, managing partner at All Source Investment Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. As we have been discussing, President Trump announced that he has reached a deal Friday to spin off the U.S. operations of TikTok from its Chinese owner ByteDance. And in addition, Trump said he would be meeting with Chinese President Xi Jinping next month on the sidelines of the APEC summit in South Korea. For more on the potential impact, we heard from Alicia Garcia Herrero, chief APAC economist for Natixis. She spoke with Bloomberg TV host Shery and Avril on the Asia trade.
So, Alicia, we just heard Shery mentioning how the hopes is that this paves the way for a U.S.-China trade deal. To what extent do you think this helps to mitigate the risk for the global economy as we wait to see tariff pass through?
Well, partially because a lot of tariffs have already been imposed on other countries, and that's not going to be lifted. The only thing that we could see coming down, in my view, is probably India and Taiwan. Taiwan is on a temporary 20% tariff, and there is good chances that it will be lowered. But other than that, the rest of the tariffs will remain. So, in other words, even if we have a deal with China, we are in a tariff world, and we're going to remain in a tariff world. So companies have to realize this.
And as we wait for perhaps companies to realize this, we're watching out for hard data as well, including from South Korea. Trade data for the first 20 days hopefully gives us a glimpse on global demand, chips exports as well. What are you seeing as the trajectory for the rest of the year?
I think we already have some signs, and you're right. This Korea has the best kind of forward-looking data. It's very quick to see what's going on, in the shortest space of time. But we already have Singapore. I mean, past data has been horrible, and I think this is what we're getting. The exception is actually again Taiwan, because the chip cycle is different, especially high-end chips, GPU-related chips. There we still see a lot of demand, but we could be surprised by South Korea, as you mentioned, because we already have the ban on NVIDIA GPUs from China. So we could start seeing that even for these very demanded high-end chips, we may see a different trend, and not because of tariffs, but because of outright prohibition this time around from China. This is also affecting trade. So, everything we hear actually is negative. Even if we get a trade deal between the US and China, negative on trade, negative on global value chains. That's where we are now.
Alicia, we often talk about a two-track economy when it comes to China. Could that two-track economy also be sort of understood as this exuberance over IT, tech, these semiconductors, and really Beijing investing in these sectors, as opposed to the real estate market that continues to drag the broader economy?
Yes, absolutely. And I would put even more sectors in this second bucket. I would argue that China is in a dual economy, as you said, but it is government-driven. It is not so much that on its own, China can actually use this first part of the economy, as you mentioned, IT, semiconductors, just to run the whole economy. We know that because times have been absolutely wonderful in terms of exports of all of these IT-related, or if you want, green tech-related also sectors, but it hasn't been enough. we know that companies aren't making any money because they are in this involution situation. They need to basically fight to get market share by cutting prices and cutting their markup on top of everything, meaning the actual room to increase prices is also shelved. So because of that, I think you cannot just run an economy of the size of China with one part of the economy. It's just too small. We need to remember the real estate sector was actually much bigger than the IT and semiconductor sector in China. So it's just not enough. And that's why I think that these efforts will eventually have to shift to the rest of the economy.
When are we going to get a monetary boost? I mean, we get loan prime rates, nothing expected for today, but then could we see something later in the year?
We're expecting 2 cuts, 10 BPs each. I realize this sounds little compared to what the Fed might be doing. So in terms of, the interest rate differential, actually, China will hold ground, but we do expect some cuts because, as you said, the rest of the economy, and increasingly even the export sector, to be frank, is showing that it isn't as resilient as it used to be in the first half of the year. So yes, we do expect cuts, not too many, because again, China has to make sure that there's not a extreme capital outflow coming from a very large interest rate differential with the US. So they have to keep it there. And that's why we only have 2 10 BP cuts up to 2026.
Even as we talk about cuts for the Fed, for China, for the BOJ, it's about hikes. And we've been seeing how the markets look relatively resilient despite what the BOJ signaled last Friday. To what extent do you think is that providing some form of cover for quantitative tightening or rate hikes from the BOJ?
Well, you're right. The BOJ somehow is going against the tide because we see Bank Indonesia cutting. I mean, many, not only the Fed. Yeah, it's like everybody's saying, "Oh, the Fed is cutting. There you go. I have some room," and everybody's worried about tariffs, so everybody's kind of in that easing mode, except the BOJ. But we need to remember the BOJ is already in an exuberantly, excessively, in a way, lax mode, because of its humongous balance sheet beyond the very low level of rates. So in a way, it goes without saying they need to tighten a little bit because they have no room. If anything happens in Japan, the BOJ has no room. This is why I think the BOJ will need to hike this year, maybe just 25 BPs. This is what we have. But it's a signal that the BOJ is back to play the game of a central bank that has some room. And this brings us, of course, to quantitative tightening. There's no better case for the BOJ to start disposing a little bit of those stocks that it bought. And there's no better time because the market is at its top, and the Nikkei is just expensive enough for them to stop without a consequence.
We'll be watching those ETF sales. Alicia, good to have you with us. Alicia Garcia Herrero of Natixis.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.